Good afternoon. It's wonderful to have everybody here. It's been a long day. I know I've been sitting in all the sessions and I get to the point where I was like, oh, I'm kind of tired now. I can see why people take a break. But some great stuff. And I think this last panel, I'm very excited for this last panel. Unfortunately, I do have to go to the other session, but it's being recorded. So I'm going to watch the recording later. I'm pointing at Sarah because she's my managing editor and she's moderating today. We're very excited to see how good of a job she does. I'm teasing her. Sarah has actually been with us how many years now, Sarah?
It'll be 14 on October 1st.
14 years. Give her a big hand.
Started at 10 years old.
She's the managing editor for the Crittenden Report. Is doing a fantastic job. We're excited to have her here. She's helped us put together this panel and we asked her to moderate it. But before we do get started, I just want to recognize at lunchtime, our sponsor was Exchange Loans. And right after this is our networking reception, and that is sponsored by Arena Investors. So when you do get out there, please drop by their booth, say hi to them, say thank you, and enjoy yourself in that cocktail party. I'm guessing you're going to have a few more people coming in as we get started, but I'm going to go ahead and give you maximum amount of time here. If you guys end early, no problem. You just open the doors, everyone can go out and enjoy themselves. But if you want to go the full time, you're welcome to do that as well. So Sarah, I'm going to turn it over to you.
Thank you. Again, I'm Sarah Havlina, managing editor at Crittenden Partners. Got some great speakers today. I'm going to let them introduce themselves and give you a little bit about them.
I'll start. My name is Sanat Patel. I'm the Chief Lending Officer and co-founder of Bank Capital and Distinction Financial. We're a bridge to perm lender for pretty much all asset types, but niche in hospitality.
I'm number two. I'm Brent LeBlanc. I'm with Peachtree Hotel Group in Stonehill. Peachtree is a fully integrated real estate management platform with a focus on hospitality. We have a acquisitions arm. We've acquired over 100 hotels. We've got a development arm where we've built over 40 hotels. We have a lending arm, which I'm representing today, along with Jared, with one of our sister companies, Stonehill, which we've done over 200 loans with a dollar amount at about $3.5 billion. We have 11 funds total between Peachtree and Stonehill, and we have about $2.2 billion in equity deployed currently.
I'm Jared Schlosser. I run Stonehill Pace, which is a subsidiary of Peachtree and Stonehill. We do about $200 million a year in Pace financing. For perspective, there were about $550 million done last year in Pace. It's still a new evolving industry. Of that $200 million, about 70% of our business is hotel. Along with the ability to do senior and pace on certain assets that we want to do on the hotel side.
Big thank you to Jared. He filled in at the last minute for another speaker. So thank you again for doing that.
He had no choice.
I just want to hang out with you guys.
Yeah. So I know we don't want to relive the last year, but I think it's kind of important to kind of review what's happened with hotels since the pandemic hit up until today.
So I'll start. I think, hospitality was a four-letter dirty word. It probably still is in some markets and certain circles. But I think we've all envisioned, we've all seen it come back. Obviously, leisure's come back much stronger than the business and the airport markets. But if it shows the resiliency of the industry, I think that's one thing that needs to be remembered by anybody in the lending side of it, is that we've got developers, owners, and operators that are committed to this asset and that this is their business. And so they roll up their sleeves and really try to make things work. And we've all benefited because I think the market is continuing to come back. Some markets better than the others. So I think the fact that hospitality is here to stay, it's still a market we want to lend into. And my colleagues, both Jared and Brett, I think it's something that we're going to see some growth in. Obviously, the brands have, the brands are very proliferated in the market. The question is which markets, which brands, and that's what you got to really think about. So we're all being a little bit more prudent in terms of the capital we put out, but it's with people we know, sponsors that have performed, that have shown how they've survived through the COVID era, and the person prospering going forward. So that's the function of what hospital has done this year as a senior lender. That's what we see and that's what we look for when we talk to our developers.
Yeah, so I'll talk from an owner's perspective. It was really market to market, and it was really tough. Leisure crushed it, but downtown urban markets not so much. And there's still a lot of pain left to come in some of those downtown urban markets. Portfolios are coming back. The summer really had some positive momentum for hotels. The challenge is kind of moving forward from an owner's perspective is labor costs are up, construction costs are up. And but through this black swan event, through this downturn, whatever you want to call it, the hotel business showed some resiliency, and I think some strong resiliency. And I think there's some positive things that are going to come out of it.
I'm on the PACE side. We, certainly we had a challenge where PACE is tied to construction and there was no construction lending. But what we figured out throughout 2020 was that there were 14 states that would allow you to go retroactively and do a PACE loan if the property had been built over the last 36 months, and essentially use that as a form of rescue capital. And instead of, getting an 18% or 20% emergency pref loan, we could come in and do PACE and work with the senior lender to solve for something, whether it was an interest reserve or, paying down the loan or what have you. And the key to it's not only the liquidity injection, but the fact that the payments don't start until 2 years from now. So you're in 2023, 2024, when, Smith Travel Research is expecting a big pop. And so it became a really attractive, form of rescue capital. And we've, been kind of the leader in the PACE space in doing that. Now that things are better, obviously we've kind of shifted to construction, but in certain markets that are lagging, we're still doing that.
Yeah, when we invested in the PACE space, what was that, 3 years ago, Jared?
2019.
2019. I mean, we did that because we thought we could go out and do a 60% senior loan from our balance sheet and then do 20% of PACE on top of it, do an 80% loan to cost on construction and just blow out the construction market. Obviously, COVID put a halt to that. So we had to figure out how to make PACE work in a very tough environment. And like I was talking to Bob earlier, and Bob said, I can't get a senior lender to consent to PACE. Well, when COVID hits and there's cash flow issues, there was never a better time for them to consent to PACE when the borrower went to them with a good business plan to say, hey, I'll pay you down. You've got less exposure. I'll fill up some reserves. I'll get my FF&E reserves back up. And so it was a smart business plan, and it made sense for the senior lender to consent to PACE. So last year we were super active in providing retroactive PACE, and certain states, it was very advantageous to do that. California, Florida, we got a lot of traction where, hotels had just opened, there's no cash flows, and it really got them through. Because on the Stonehill side, we were pitching rescue capital, and we thought those opportunities were going to be plentiful. However, at 20% rescue capital rates versus 5.5%, my counterpart won every day of the week. So, no questions.
Jared, when you're doing a rescue capital deal on an existing project and stepping in with PACE to replace money that's been spent over 3 years, is the senior lender letting you become superior lien ahead of them?
So PACE is a tax lien with no rights and no covenants and no ability to accelerate. So what they're really doing is solving for a situation that benefits them in that scenario, which is, do I have to put out my own capital, or can I use the PACE to solve for whatever liquidity need I have, and then reserve for a payment that is 2 or 3 years from now? And so it comes down to structuring, right? So for instance, if you come in and you do a retroactive PACE loan and the senior lender takes the annual payment as a reserve at close out of those proceeds, they've now solved for 3 years. Well, most people's terms are inside of that, right? And we created our PACE to be flexible so that, you know, on one of Sanat's deals, right? If he wants to be refinanced out, we don't put some yield maintenance on our paper that makes it impossible to refinance out, right? We know that we're probably only in those deals only going to be in the deal for as long as they're in the deal, or whoever whatever senior lender that you're doing it with.
And from a senior lender perspective, what Jared said is very important. The PACE proceeds comes in, helps pay down the senior debt by a certain amount, builds the reserves for future payments while we come out through this downturn. And in essence, shores up the capital and the payments for us, which benefits the senior lender. Now, the challenge is, and it's lender by lender, and Jared can attest to this, you know, most credit officers say it's, when Jared said it's a tax lien, they go, okay, I'm putting myself in a junior position.
Yes.
But from that perspective, yes, you are. But here's the thing. If I'm already lending at an 80% loan to value, and my values have decreased, having Jared come in and put in some additional capital, pay my loan down, I've bettered my position. So it's a case by case situation, and you have to really explain it. And that's probably the hardest part. I think that's probably every loan has to be explained in that manner. So we as a PACE lender, we as a senior lender understand that. And as long as we both have interest that are aligned in saying it's not quote unquote equity, it's actually debt, that in the sense of how it's viewed that way. If you do it that way, then you can go. So it's lender by lender, unfortunately. And as Jerry will attest to it, it's almost county by county, because certain states have unique regulations, so you got to work through that.
But that won't necessarily apply to construction deals, only when you've got an existing 3 years of infrastructure money.
Yeah, I mean, it's the same concept in theory, though, for a construction loan, right? I think the struggle with PACE is that you get guys in here that tell you that it's equity, and they want the senior lender to go to 95%, and it's just not going to happen. And so if you look at it in a way that it can benefit the senior lender, i.e., you know, they're at the same last dollar, but it's lowering the overall cost of capital, or it's lowering their exposure because they're getting ample reserves, but they're only lending, you know, like in that scenario, 60%, still works whether it's construction or retroactive. It's just, I think that, you know, the business being in its infancy, you have a lot of people pitching it that are more geared towards energy, and they're not necessarily finance people. And so, you know, they start off a lot of these lenders on the wrong foot by saying, hey, we're equity. And that's not what this is.
What does it take to get a hotel loan today? What's the key criteria that you guys are looking for? What's number one?
The firstborn, secondborn, you know, provided they're productive. No, in reality, and from a senior lender perspective, experience is everything. And I think all three of us would agree that's probably the first test we all go through with any borrower on a new loan, is their experience to go through. If they're saying, oh, I've owned this, but this is the first one I'm building, we're like going, okay, maybe we're not the right lender for you at that point. So experience is key. You've heard it said in numerous occasions, cash is king. Cash flow, liquidity, excess capital, excess balance sheet is always very strong, very helpful, but that doesn't mean you have to sacrifice all of it to get there. Typically on a senior, we're looking at 65 to 75% loan to cost type financing. We bring in Jared's group into the PACE, and we'll step down for them to be at 75 total all in. But it has to work across the platform. You know, when you have developers who are expectations, I want to be at 85 or 90 on hospitality, that's hard for us to get comfortable. It just is. And you have to, and those are deals that are not getting done. So I think the loans that are getting done are good markets, good experience, and developers that have actually gone through a recessionary cycle and understood what it takes to run a business. And and we ask, as a senior lender, we ask, how did you survive the global financial crisis? What did you do? How many keys did you give back? What did you do with your senior? How did you work out your situation? And if they've worked through the situation, then that says a lot about the developer in terms of their experience and character. And that's what we lend into that.
And I think we're very similar. I mean, it's still a very tough market. There's limited liquidity for hotels right now. And really what it boils down to is what you said. I mean, who's the sponsor? What's their business plan? And it's really deal to deal, market to market. And there's not one size fits all. But this is no better time to underwrite the sponsor and his business plan and his past experience.
And one thing I want to say, I hope there's no crazy, but feasibility study will always say what you want it to say. It's never going to come and say, don't build or anything like that. So we as lenders really look at a feasibility study as sort of a rubber stamp if the regulators need it, but it's not the catch-all to, hey, this is a good market, a good project.
And the appraisal from 2018 doesn't work anymore.
Good for some other use, but not.
Yeah.
What type of hotels are getting the most lender interest? And then what do you guys go after?
If there's something in the leisure market today, that's a brand, it'll get a lot of attention. I think we'll be 3-4 lenders bidding on it. Of course, it gets very competitive. New development, it's going to be really, something we're looking at now when we look at new development is, okay, what are the demand drivers? Where is Amazon's nearest facility? What's going to drive, what jobs are they doing in this market? The whole concept of work from home, which we're all still getting used to overall, we're seeing what demand drivers are going to force somebody to travel. If it's a central business district, with the business traveler, that's going to be where you're going to look and say, what's coming in that market that's driving it. If it's Austin, great. If it's, somewhere else in Texas, maybe not so great kind of thing. So those are factors that are going to really look at what's going to help us understand and lend into a certain market kind of thing. And again, experience, as I said earlier, those are factors that come into play.
Yeah, we focus mostly on limited service, select service, compact full service, some type of lifestyle component, 200 rooms or less. Drive to leisure markets have proven through the pandemic to be the most resilient. It gets very competitive. We are doing a ton of construction debt right now. I probably have 600 million under application for construction at pretty heavy pricing. We'll stretch on leverage. However, you're not going to find a senior, local or regional bank to do construction right now. It's very difficult.
To just add to what Brent said, select, limited service, both getting done, flag in certain markets, getting done. The full serve box, big box, we struggle. As a senior lender, we struggle. But then there's other institutional lenders that will step up to do something like that. But it's got to be a very compelling reason in terms of market, rooms going out of market, and then new rooms going to be kind of thing. If it's just add-on rooms, and the question can be, well, what's going to be driving the occupancy back to the level it was on pre-pandemic level? That's the big thing.
Yes, and I'm sure you've seen the same thing from your originators. I mean, we see a lot of big box junk. And the call goes like this. Well, the basis is great. Well, we go back to pre-COVID. I'm not going to finance any acquisition or recap anything that, or construction wise, if it wasn't doing well pre-COVID, I don't think anyone has any interest post-COVID. So that's the one thing, including the sponsorship, is if it was declining, and it's very easy to determine that.
And the brands, when I said they live through the market, they let sign on new agreements and whatever, thinking things were going to continue being good. But COVID's proven that to be something to be different. And we as lenders now have to prove saying, is this really needed in this market? If the basis is great, fine. But that doesn't mean the revenues come to support that in the future. And that's what we're looking at.
What about terms, leverage, rates, recourse? What are you guys looking for?
We're we're typically recourse as a lender. We will do non-recourse, then you step down in leverage usually in that regard. If we're partnering with Jared's group or something like that, we'll step to 75 loan to cost and their portion, their sub portion. So, terms wise, we'll give it 3 to 5 years, 2 years to build it. 1 year terms to kind of go stabilize it. We're not in it for the long term. As a lender, my capital is not a long-term capital, right? It's short-term capital. I'm helping you build it, stabilize it, and use it to find an exit strategy for us. And that's what that's the kind of stuff we do. So 50 to 65% leverage, easy to get down on a standalone basis. I have to bring pacing, we'll go to 75% leverage. Can we touch 80? Yes, but it's got to be true, really, really strong for us to do it. And my friends here are nodding their head because it's got to be really, really strong for them to step up to 80 as well.
That's right.
On a combined basis.
Absolutely.
Yes. I mean, so at Stonehill, we're averaging 65, maybe getting to 75,
Yeah.
maybe. Our rates 6 to 8%. And again, it's deal by deal, market to market, situation to situation. And just to compare pre-COVID, we were getting pretty aggressive and pricing some things in the high 4s, low 5s. So we're, 200 basis points above where we were at pre-COVID.
That dude just left when he heard you say 6 to 8.
He laughed.
He was like, no, this is too expensive, man. I'm out of here.
All non-recourse. Maybe he'll come back. No,
Yeah.
he's gonna get his friends at the bar.
Yeah, I mean, for pace, we never want to exceed 30% of stabilized value on our piece. We're generally priced, in that 5.5% fixed range. We'll go as long as the state that we're lending in will allow you to. Each state is different. Most states let you get 20, 25 years, or certain states like Missouri that cap you at 20. And, I think we're pretty competitive in terms of pricing and prepayment flexibility, throughout kind of our market peers. And certainly we know the lenders that are quoting hotel deals and not just seeing the volume that I see. Most bank loans that I'm seeing, and you guys can back me up what you're seeing, but if they quote at all, which is a huge if, I think a lot of players have just simply left the market, and I don't know if they'll come back. But the banks are at 50% full recourse pricing that was 150 basis points wider than where they were pre-COVID. And it's got to be perfect, and it's only for their best borrowers. So there's just, I probably get calls every single day of, hey, we want to use PACE on this hotel. Can you help us find a senior? They've really got to fit the criteria that these guys are describing. And if it doesn't, there's some outliers here and there, but, I'm not seeing boutique or difficult located type deals being financed right now.
For those that maybe don't know, can you just give us a quick nutshell on how PACE works?
Yeah, it's a state-by-state product that allows you to lend on certain line items in a construction or value add budget and get repaid back through a property tax assessment. It's designed for energy efficiency, but most of the legislation throughout the country is tied to building to code. So like here in the state of Florida, if you build to code, you're going to qualify for, 25 to 30% of cost for PACE. It's regular line items like roof, elevator, HVAC, plumbing, mechanical systems, electrical systems, major things that would be in any, construction budget or gut rehab. People ask all the time, how much can I qualify for PACE? And it's the same answer I give them. It's up to the senior lender. Because I think that, certainly we've done deals where a senior lender wants to get as low as they can in their actual exposure, and they'll let us do 30% of cost. And we have some that, just want their borrower to not use mezz and want to have a very small slice of PACE, and it's 5%. And ultimately they're, the senior lender's driving the bus on PACE. It's not the PACE lender. So I can quote you anything, but ultimately at the end of the day, it's what the senior lender is going to allow.
Okay, let's look forward a little bit. What'll be the biggest trends, changes we'll see going forward with hotel lending? Any big changes in underwriting?
That's a crystal ball.
know.
My crystal ball of phonics color. Unless let me answer the question this way. From an exit part of it, exit strategy, if it's CMBS exits or bank exits, unless they're changing something in terms of getting more open with terms, leverage or anything like that, that's going to give us confidence that we can do higher leverage or anything like that. But I don't see that happening through the global financial crisis, through COVID downturn and bounce. We've not seen them change anything in terms of their lending. If anything, global financial crisis made them hold exposure to DPs and so on and so forth. So I think the exit, as long as the exit stays where it is, which is a CMBS type of an exit or a bank exit, we're not going to see much difference in lending trends or anything like that. We're still going to be, as Brendel said, 60 to 75% of the senior leverage, and we're not going to get beyond that from the perspective. Because valuations go up and down, and hotel valuations are driven by revenue, and that's the hardest part. As anything pandemic proved, you could go from, nobody in the past underwrote to zero revenues. Nobody. And I know we all in our credit shops internally talk to them. So what's the revenue? And we saw Star Report go from 80 to 0. We're like, oh shit. How do we what's the value of the asset? And frankly, all the bankers probably got scared because we have zero revenue. That means you have zero value because it's cap rate driven. And so all those factors come into place. I don't think there's anything new. If anything, you're going to get more price competition because there's so much capital out in the market today, and you're going to see that happen. I think we've seen it in specific markets. A bank will step in and do a very aggressive deal, leverage deal, and we're like, going to take the money, sign up right now. Don't even think and just do it. But then it's that one deal in done kind of thing. And then they'll come back in once that loan gets paid off, they'll come back with another loan. So that's really, I don't think you're going to see anything new in lending trends. It's going to be the same kind of thing. And again, it's going to be experience is going to be the key for all of us and how they perform going forward.
Yeah, I agree. And we're all interested to see when corporate travel comes back.
Yeah.
And that's really a big key. And you can look into your crystal ball, but we can't tell if we're going to be able to have a meeting next week in certain states. I also think it's going to be a while before banks come back. So how we're underwriting deals is not going to change much from an operating standpoint. Of course, labor's up, construction costs are up, and we've got to account for that. But banks, I think, are going to take a while before they come back to the space. And most of the hotel projects are going to be funded by private debt funds for the near future.
To Brent's point, when banks were in hospitality lending, if I remember through COVID, the regulator said you can defer the payments and we're not going to judge you negatively. Well, that 12-month period is expired just recently. So now how they act going forward is what's going to drive whether they'll come back or not. And that's the thing. That's going to be good for Brent's business and my business, because now banks are going to say, can we just get out of this? We've got a regulatory exam coming in 3 months from now. Let's clean house, guys. Let's
That's
clear out
right.
the portfolio.
Of course. So, and Sanat and I talked about this last night. We've bought $1 billion worth of hotel paper in the last 15 months. And that's from local and regional banks. We started buying at, in the early days of the pandemic when banks and regional banks were trying to get ahead of it. They were unloading paper at 70 cents on the dollar. I would hear rumblings of, the banks are going to start selling notes. We had already started buying notes. And the key to those transactions are you don't get any information and you're closing in 10 days. Once you get the portfolio in front of you. We're paying closer to 90 cents on the dollar right now. But we have been very active, and to Sanat's point, the extend to pretend is coming to an end at the end of the year. We said weekly, Jared knows this, that the note game is coming to an end. And sure enough, it doesn't. It just keeps coming. And I don't know if we've become known as the note buyer, and we have the execution and they're comfortable with us, and it's repeat banks coming back to us to take a second portfolio or a third portfolio. They want to spread it out. They don't want to take a hit more than a certain amount each quarter. So we get a $100 million portfolio this quarter, a $100 million portfolio next quarter. And we don't see it ending until, at least mid next year. I've got 500 million more in underwriting right now, ready to close by the end of the year or the end of this quarter. And that doesn't, we could get in a portfolio tomorrow, we spread out like ants going to see, 15 different hotels, secretly walking them.
Let's talk about markets. You guys touched on that earlier, but this is what I think has been the most interesting: hot hotel markets and cold hotel markets, and how that's changed.
Take the map of the United States and draw a U on it. Those are the markets that we blend into. And then you've got offshoots of maybe the W's out in Ohio, some of the best markets. The energy markets, namely oil, petroleum, base energy, and natural gas, those are tough markets. They're just going to be tough. And looking out into the future, I don't know if that's going to be something that's going to be a market where they're going to get back into, because this is great push, clean energy, climate change is real, everybody's waking up to it. So I think that's going to be hard for us. Brent said it earlier, the drive-through leisure markets, great markets to lend into. If you can get properties in those markets, that's going to be, you're going to find ways to go through. Certain types of hotels that are good also, the extended stay segment. We've seen that market be very resilient. If anything, that market saw a very little bump, very little downturn, and kind of had a very nice bump after post-COVID. So that's what we're seeing. I think. The sunshine states are always going to be good. People are going to want to get out of cold environment and get into warm environments. And then you've also got to follow population demographic. What are people, where are people migrating into, and where they're migrating out of? If they're going out of a state, you got to think about it. Everybody says California is great, but you also look at the mass exodus coming out of California, and it's that's where you got to be mindful of that. That's how we're looking.
Yeah, I mean, it's really drive to leisure is the hotbed, and we have, I'll put my acquisitions and my development hat on. We had several equity investments on the sand in the panhandle of Florida, throughout, down in this area over to Tampa, and, Austin too, where we were either building hotels or, had newly opened hotels. And it's simply mind-boggling, the unsolicited offers that we got for those assets. And we could make a point or probably prove that the pandemic increased the value on these hotels in certain markets. And we sold, or we're under contract to sell. But drive to leisure is going to have a heavy demand. I mean, I hope it ends, because I can't go to my beach vacations that I usually go to because I can't afford it. Right?
Yeah, and I think also when you look across our portfolio, we own a lot of hotels in college towns, and that genie's out of the box. I don't know if anybody saw the Alabama-Florida game this past weekend, but we own hotels in Gainesville, and there's 90,000 people in that stadium, and I guarantee those hotels were doing great this weekend. So I think any hotel in a college town that's well positioned with a good flag on it is going to do well coming out of this thing, because people are going to go to games.
Yeah, we just closed on a $104 million construction loan for a Margaritaville resort down in Fort Myers, Florida. It's the biggest construction loan we've done. And we're in love with that brand. I mean, if you see the numbers on that brand in certain markets, it's mind-boggling, the amount of revenue they produce. And it's not from the rooms, it's from the F&B. It's crazy.
What's your loan to cost on a deal like that?
65 to 70%.
Did you do some measure prep equity on top of that?
No.
Somebody else,
Mm-mm.
just to see.
Just a senior.
That segues beautifully into hotel construction lending. How do borrowers even get that financed or even get somebody to pick up the phone?
I'll pick up the phone.
Or do this, we can set up like a 1-800 call, 3 of us. Or something like that. You know, that could be something we can do after it's gone. Really, it's hotel, we never stopped lending through COVID for construction. And I think Stonehill did as well.
Correct.
I think we all went through. So if anything, we all took a pause on markets we didn't want to go into because of, we were not uncertain of the recovery. Brent said earlier, the corporate business travel market, when that comes back, the central business district lending in that market is going to come back as well. But until we see that happening, I'm not sure we're all going to jump into that and with both feet basically, dip our toe into or anything like that. So to get a borrower, when a borrower calls for us to pick up the phone, we'll answer the call. We'll tell them this is what we can do. The challenge, I think, is the expectation of pre-COVID financing and post-COVID financing in terms of what we're doing. We're doing a little more due diligence. We're asking the tougher questions. What happens if the costs? We also know construction costs, as Brent said earlier, they're going out of labor and construction costs are much higher than they were in 2019. And in 2019, we were all saying, can this go any higher than what it is? We're far higher than that today. So those are factors that are going to play into how we lend into that for borrowers. We were 65 to 70% leverage as a senior pre-COVID. We're 65 to 70 as leverage during COVID. We're 65 to 70 post-COVID. So our box hasn't changed. What we're now looking at is how the costing comes into play. The per key development cost is going to be a big thing we're going to look at. Certain markets you can be 100 to 150, and that's fine. But if you're in a secondary or tertiary market and you're thinking 100 to 150, we're going to say, how does that come back and we get repaid? It just doesn't make sense. So possibly you may not want to build, or you may want to downsize to a smaller brand or cut out the rooms or whatever, but that has to all make sense. So we're just asking more qualifying questions at the front end here. Pricing has been pretty constant, I think, across the board.
Mm-hmm.
And debt funds haven't changed. People get concerned because banks jump in and out of this space. They've always, in hospitality, they'll come in and they come in usually 2 years before the market falls out, and then they run away and they come back in immediately. So that's the hard part. So debt funds like ourselves, Stonehill, we've been in it and we're going to stay in it because we know this is a very resilient market to lend into. And it's a good industry at the end of the day.
Yeah, and it's 2 years away from opening.
Exactly.
And if we're still in the shape we are in today, then we get bigger problems. And we're getting paid for construction. As I said, we've got about 500 to 600 million in construction under application, either closed or under application for this year. And we're 65 to 70%. We're in the 8s in pricing. And, some people hang up the phone on me, but they usually call back. And they'll call back.
And the irony is that, you see a lot of these debt funds on bridge deals kind of jumping in here and there and pricing inside of all of us, trying to find leverage in their portfolio. And honestly, the right play is probably to do a construction loan, because if that delivers 2 years from now you're going to have a brand new product that's in a market competing against a bunch of properties that probably have deferred PIPs with people not able to put cash into them. So I think that's where the market's kind of missing, is that, for the right brand, right sponsor, right piece of real estate, it's a great time to be a construction lender. But I think these guys are doing it every day. I mean, I think between the two shops, if we wanted to sign up a construction loan every day, we probably could have. Because we're picking and choosing, because there's really just no one in the market right now. I am doing PACE deals with some banks, and I think the profile is generally somebody who's been to a bank for a long time, and like Sanat said, they've been through cycles, and that bank trusts them, and they're probably using PACE to get where they would be otherwise. So if they used to give that borrower 75%, they'll give that borrower 55% and throw 20% PACE in there, and they'll get back to that 75%, but they'll have it in a different context.
And some ask me, who would sign that up at 70% in the 8s? And you'd be surprised. Some of the bigger developers in the country. I mean, it's short-term money. It's short-term money.
Not only that, what we can give them is a certainty of execution.
That's right.
When our shops, our respective shops, get around a deal, we'll sit down and rip through it, and we'll kind of figure out how quickly we can say yes, fix it. Or we'll tell you we're very quick no. We're good to do that as well. Banks are in the maybe business. We're in the yes and no business. And so if we can do the yes and no quickly, we'll do that. And time is limited. Brent wants to say yes. I want to say yes. Jerry wants to say yes. So we try to focus on those rather than the ones that we just can't do.
Yeah, I think we were talking yesterday that for the recaps and the acquisitions, we're seeing some off-ball quotes come in, and we don't have time. I don't have time. I got a call yesterday from the head of Marriott Development, and said, "Hey, I'm sending you this guy. He needs construction financing." And so the guy calls me, and I go, "Well," he goes, "Well, I've got options." I'm like, "What's your options?" "Well, I've got a 80% offer at LIBOR +4. I'm like, "Why are you calling me?" And he was lying, obviously. Or it's not time to play games if you want construction financing, because I'm not going to spend a lot of time on the phone with you.
Those are the callbacks. We always say those are the ones that call back. LIBOR was 4 terms, LIBOR was 6%.
I also think, one thing that's really helped both of our companies is how we treated people through COVID. The borrower profile that I've seen of our loans has increased tremendously because we treated people the right way. We gave the deferment. Our portfolio went to 0 occupancy like that. And, today it's all current, and it really, we tried to give people as much time because we're hotel owners, right? We understand what they're going through because we're going through it too on the equity side. And, there were a lot of people in the space that didn't have control. They weren't balance sheet lenders, and, they were sticking it to people. And, if you're a borrower that went through that, are you going to go back to that style of lender again?
The other thing is what Jared said, we're active management of our portfolio. Banks were told extend it to 10. So they put it away for 12 months, didn't think about it. Now they're all waking up thinking about it now. And whereas we went to our borrowers, Jared said, we gave them 3 months, 6 months to firm, put them back on interest only and say, we'll catch up starting this year or sometime this year. That's how we actively manage our portfolios. We have that conversation with our borrowers. That's what CMBS said, we'll issue reserve to make payments, and then go to special servicer, and then now they're having that struggle. Banks forgot about it. Now they're waking up to, oh shit, we have a portfolio that we don't have any payments for 12 months. And developers, borrowers now, once you give them that drug, they're gonna come back and say, can I get 6 more months of that? So we actively manage, and I think that's the other thing that's helped us.
Brent, you touched on this earlier, but can you kind of talk about hotel investment, that market right now?
Hotel investment?
Yeah.
As far as acquisitions?
Yeah.
Yeah. So I think in the beginning of the pandemic, we didn't see a lot of acquisition opportunities. And if we did, it was the big box kind of junk that needs to be torn down, in my opinion, or it needs to be imploded. So there just wasn't a lot of transaction activity for us to do a bridge loan on or a recap. So, I mean, we probably would have been more active if there was more opportunity. It just wasn't there. And then, as I was saying earlier, all the nice assets that were being built and leisure drive to markets commanded a premium pricing. So, you know, we were sellers at that point. We weren't buyers. I think in the last 5 or 6 weeks, you've seen a lot of broker activity with better quality assets coming around, which will pick up the transaction activity, which will pick up our business from an acquisition lending standpoint when there's limited capital out there. So I think what's going to happen is, as Jared said, you've got a lot of hotels that are being capital starved. I've walked a lot of hotels. I've probably walked 50, 60 hotels in the past 6 months. And I call it the COVID effect. You walk up and, you know, the first thing that you see is the grass hadn't been cut and there's weeds up to the windows. And some you walk in and it smells nice and it's a nice hotel, and some others not so much. And that doesn't mean it's not a nice asset, but they cut corners everywhere they had to actually survive. And what's going to happen is the brands, it's coming to an end with the brands. The brands are going to say, hey, you got to get your hotel back up to shape. That PIP, that property improvement plan you had to perform on that hotel that we've been ignoring, now you've got to do it. There's no capital to do it. So I think some of the cash flow issues have been masked, and it's going to be unmasked. So the point is, are the owners going to put the capital into these hotels, or is there deal fatigue and they're going to just sell it and let somebody else do it? So as far as acquisitions and investment, I think the activity is picking up pretty quickly, and I don't think that's going to stop over the next 12 to 18 months.
The only other thing I can add to that is that as you see hotels, banks putting out portfolio, starting to sell some of that, you're gonna see that prices pick up with that as well. So that's the drive. We'll see what happens next 6 months. I think it's important.
Okay, crystal ball again. When will hotel lending return to normal levels?
Well, in our shops, it was just normal, right?
That's right.
I think normal is defined by what banks jump into it. And to what I answered earlier, banks usually jump into this late in the game. They don't come into it when going is good right now. So I think it's probably going to be. Well, we can take that back. You read the paper, I'll come back and say, well, we maybe we're going to start to raise rates as well and see how we curb growth. How we come out on the backside of that is probably how when I think hotel lending will come back to Brad said earlier as well, corporate travel. We're still all figuring through until any of us can sit there and say, okay, I think we're through this pandemic completely, where COVID's not a big thing anymore. Then I think hotel lending will come back. Until then, I don't see it coming back. And COVID cannot take the front line or be on the news cycle for a while before it comes back. It may be COVID 2.0, something else. Start the Indian alphabet or the Sanskrit alphabet or something like that. We're going to run out of Greek letters pretty soon.
So my crystal ball says never. I think banking is changing, and it's changing daily. It really depends on your definition of normal. I think what you see across the landscape of banking is, Jared and I talked about this last night, consolidation of banks. And when a developer had a banking relationship at a local level that could go in and get that 80% financing at 4%, that's not there anymore, or that bank has been sold. So I don't think it's ever, with the consolidation of banks, it depends on your definition of normal. It is normal in our shops from a lending standpoint, but from a local and a regional standpoint, with consolidation, I don't think it'll ever be normal like we knew it before.
Yeah, I mean, I have an entire business built on the thesis where it's not going to come back to normal, right? That's why I exist. If it goes back to normal, I no longer exist and I got to go hawk bridge loans for Brent. But I think we're going to end up seeing, pace in almost every hotel deal because, Sanat said earlier, the hotel business has generally been financed at 75, 80%. That's not there for the most part outside of, our shops and maybe some other people in that peer group. And so you're going to see pace on pretty much every bank loan moving forward because I don't see outside of the small, 1 billion and under community banks, people throwing out 80% bank quotes. I think they're going to be at 50, 55%, and they're going to rely on the pref equity, mezz, and PACE community to bridge the gap because most people just don't have 45% to put in a hotel.
Can you each give us an example of a hotel loan or deal that you closed and kind of go over the hurdles, anything unique, anything interesting?
So we did
As many as you want.
I got one.
This was it was a repurpose of a historical building into a studio brand, Crittend's soft brand. And we have base, we have tax credit in the deal. All in all, leverage was around 78%. We put in tax credit base and our senior debt too. It went over budget by about 8%. So there was some stress between us and borrower. I'm not sure, but there was stress. But we would work our way through getting the project finished. The developer came with them with their capital. We never had a little bit more. By the time it was all said and done, we were at 80% from the initial cost perspective. But we were refinanced out by the bridge lender that stepped in and said, "Oh, we can do this thing." They stepped in and I said, "Hey, if your money's smarter than mine, by all means, take it." And we were refinanced out. And I talked to the borrower 2 days ago and he said, "Yeah, we're actually doing well. It's stabilizing. It's not hitting the numbers we wanted it to for our projections. But it's a marketplace. It's the leader back in terms of the newest on the street. And that's what you heard earlier in one of the conversations somebody said. When you're the newest hotel on the market, you're going to get the best rate. You're going to get the best occupancy. The question is how you survive when you get on the other side, when the other hotels start moving. So that's the deal we do today. I think what the rest of the learn is that we could not nobody foresaw the rising labor cost as it progressed in the years that we went into the pandemic. And that and materials cost created an issue for us. No.
I go one.
No.
Jared gets 0. Yeah, really, I was thinking about this and we just closed on an acquisition in North Dallas of a Hampton Inn. And I was trying to think about why it was a smaller loan, 18 million. And the challenge is there, and it got limited looks from capital sources. And I was trying to think of the reasons why it was getting limited looks, or there was not a lot of interest in it, because it was a good market, good brand, new franchise agreement, length of term on that franchise agreement. They wanted to add rooms. They wanted to add 20 rooms to the hotel. So it added a construction component to it. It was a new real estate fund, or it was a new debt fund, and they did not have any hotel experience, but they had a ton of great real estate experience and hired on a really good guy to work for them that had a ton of hotel experience. So that brought that to the table. So I think they had a lot of negatives to the market for this deal. And they wanted the ability to build rooms, but not have the ability to build rooms. They wanted the capital future funding there if they wanted to build the rooms. And we got there and we closed in 40 days. And we're able to execute and see their vision and their business plan and give them what they needed. So we tried to solve for what the capital stack needed and what the developer needed in that situation.
Yeah, we just closed on a deal a couple weeks ago here in Florida. Borrower came to us, wanted to use PACE, introduced him to a senior lender that I'd closed with before. And we basically put the entire capital stack together. It was 80% of total cost. We were 20%. The senior lender was a bank at 60%, full recourse. Strong borrower, strong flag, good location. So it really was just about introducing to somebody that we knew understood PACE and understood the structure. And that's what I think we've been effective in this market in doing, just given how close we are, not only across the board at being a debt fund, but just in the hospitality space. We know the people like Sanat that understand the PACE business, and we can make a couple introductions here. I'm not trying to broker somebody's deal or whatnot. I know a few guys that I like working with that, understand PACE and can get something done, and I'll make an introduction and hopefully it moves forward. And, the senior lender's got a relationship with us, so they're going to protect us in that scenario. So I don't need to, have some sort of agreement or whatnot. And that's what we did in that deal is introduce it to a senior lender to put the capital stack together.
Jeremy, what kind of prepayment do you have on a PACE deal after like 3 or 4 years? Should the borrower get out of that?
Yeah, I mean, every deal is different, right? But most of our deals at that point are at 1%. Yeah, I mean, it's manageable, particularly, if you're looking at the alternatives, which is the way that PACE should be viewed. If mezz is 12 and 15% and pref equities in there, 2 and 1% prepayment on top of a 5.5% rate blended over 3 years, that cost is pretty accretive. There are other people in the space that may be cheaper, but may have yield maintenance or for the first 5 years or some crazy prepay. I think you're better off chasing the flexible prepayment, because at the end of the day, I don't have a Ouija board and I can't tell you what the adoption is going to be for PACE at exit. I think that, it's going to be, when I look at when we started this business in 2019 to who's consented today, there's certainly been a lot of adoption. And I think with ESG, I think that PACE is, much like mezz 15 years ago is going to be relatively adopted. But in the event that you can't, you got to get out of it. And so you want something flexible that you can get out of if you can.
Quick question, you're a national ground lease investor?
Hold on, she's asking a question up there.
Oh, sorry.
You got to acquire a voice.
Wow, way better. How heavily, that's happened before. How heavily do y'all weigh the flag of a construction project? Like Brent, I know we've spoken recently, Wyndham is really tough for you guys right now. What do y'all look
Did I
for
say
in
that?
that respect?
Sorry. There's no Wyndham guys in the market. In the room,
I know, right. And I know that can change and it's cyclical, of course, but just how heavily do y'all weigh that in underwriting when reviewing a construction project?
Very, very, it weighs heavily on our decision.
Absolutely. Do we like Wyndham? Certain markets, but it's not a flag that we very honest. But flag has the top 4, probably everybody wants to do. But even out of the top 4, there's one that we'll probably shy away from.
Yep. Of course.
We're not gonna say that name at this point.
But the reason is why, right? And that's probably your next question. And for us, it really comes down to the exit. What is the exit out of this asset? And we can underwrite a Marriott and Hilton brand, the exit, with our eyes closed. In the pool of buyers, or if there is a meltdown situation and we have a premium brand with Marriott and Hilton, we know what that downside is if we had to take the hotel back. And we know where our exit caps are going to be with a Marriott. And we're not saying Wyndham, Choice, and those brands don't work because all the brands have, and I ran development at Starwood Hotels for many years. And, we had some subpar brands. But I sold those brands to a lot of people, and brands and there's always a fit somewhere, someplace for that brand. But just because it's the last brand in the market doesn't mean it needs to be built. So it's all about the exit for us.
Super helpful. Thank you.
Hi, thank you. We're a national ground lease investor, and I'm sort of leading up the hospitality side of our business. And I don't know if you've worked with ground leases. We're trying to create a very leasehold lender-friendly product, which we in fact have. And just wondering what your attitudes are. The way this product works is it's basically there's no fee. Rates are down in the low 4s today, and most of the provisions are really in favor of the leasehold lenders in terms of default provisions and covering, condemnation and insurance provisions, like casualty loss, those sorts of things today. So just wondering what you guys were thinking about in our space.
From a senior lender perspective, we struggle with ground leases, to be very frank. I've had conversations with people that are saying that's part of the capital stack that allows you to reduce your basically. If that's what you're doing, monetizing
Right.
A certain portion of it. We've not done anything in that space. We say, can we learn? Yeah, we can.
Sure.
The question is going to be what you may view, as you said it earlier, provisions that are lender friendly. That's your version of it. I don't know if that's our version. Well, lender friendly. So that has to be negotiated or agreed upon what that is. For us as lenders, the question then becomes, as Brent said, what's the exit? Who am I, if I have a ground lease and I have to take over and I'm the lender who has to foreclose on it, then who's going to be a buyer that's going to come and take this asset and wants to assume that ground lease, for example, or buy out of this ground lease? Those are factors that are going to play into our decision of that. So
Right.
I think the question is, what is lender friendly in your view compared to what's lender friendly in our view? And what are the buyout provisions that are in place today that allow us to exit? Because if I have to buy it out to now buy out your lease, now increase my exposure, only to then go find the exit, that's going to be the challenge for us.
Yeah.
That's how we view it.
Right, you talked about that you guys are buying hotels for your own portfolio, but buying hotels for your own portfolio. Is that the equity money that goes in to your purchases? Is that kind of equity money available from you to do other deals like in joint ventures, or are you limited?
JV equity?
Yeah.
We do JV equity.
You do. It's not just a pref equity that's maxed out at 75%
No,
or 80%.
We're actively doing, we're ramping up our development arm as fast as you can imagine. We'll probably build, 10 to 15 hotels in the next 18 months, or at least start that development. So we're ramping up our development arm quickly. Most of those developments in the past 18 months have been in opportunity zones. We have an opportunity zone fund. We deployed that fund out. We're under construction or opening. We just opened the Hilton Garden Home 2 in the Texas Medical Center last week or this week. We just opened in Houston. Yeah. We were majority equity on that deal. So we're doing a lot of development. We do have JV capital available for the right developments. I don't know if we'll do a ton of it, but for the right projects and the right sponsorship. Now, if we're going to do straight JV equity, we want to operate also. So that's one thing we want to control is the operations.
Okay, I think we're out of time. So thank you so much for coming today. And thank you, gentlemen, for your time and expertise. Really appreciate it.
Thank you.
Thanks.